is loan? How does it work? Types and tips on getting one. What is loan? The term loan refers to a type of credit vehicle in which a sum of money is lent to another party in exchange for future repayment of the value or principal amount. In many cases, the lender also adds interest or finance charges to the principal value, which the borrower must pay in addition to the principal balance. Loan may be for specific one-time amounts, or they may be available as an open-ended line of credit up to a specified limit. Loan comes in many different forms, including secured, unsecured, commercial, and personal loans. Key takeaways: first, a loan is when money is given to another party in exchange for repayment of the loan principal amount plus interest. Second, lenders will consider a prospective browser income, credit score, and debt levels before deciding to offer them a loan. Third, a loan may be secured by collateral, such as mortgage, or it may be unsecured, such as credit card. Fourth, revolving loans or lines can be spent, repaid, and spent again, while term loans are fixed rate, fixed payment loans. 5. Lenders may charge higher interest rates to risky borrowers. Understanding loans. A loan is a form of debt incurred by an individual or other entity. The lender, usually a corporation, financial institution, or government, advances a sum of money to the borrower. In return, the borrower agrees to a certain set of terms, including any finance charges, interest, repayment date, and other conditions. In some cases, the lender may require collateral to secure the loan and ensure repayment. Loans may also take the form of bonds and certificates of deposits (CD). It is also possible to take a loan from a 401k account. The loan process. Here show how the loan process works. When someone needs money, they apply for a loan from a bank, corporation, government, or other entity. The borrower may be required to provide specific details such as the reason for the loan, their financial history, social security number, SSN, or other information. The lender reviews this information as well as a person debt to income (DTI) ratio to determine if the loan can be paid back. Based on the applicant's creditworthiness, the lender either denies or approves the application. The lender must provide a reason should the loan application be denied. If the application is approved, both parties sign a contract that outlines the details of the agreement. The lender advances the proceeds of the loan, after which the borrower must repay the amount, including any additional charges such as interest. The terms of a loan are agreed to by each party before any money or property changes hands or is disturbed. If the lender requires collateral, the lender outlines this is in the loan documents. Most loans are also have provision recording the maximum amount of interest in addition to other convenience, such as the length of the time before prepayment is required. What are loans used? Loans are advanced for a number of reasons, including major purchases, investing, renovation, debt consolidation, and business ventures. Loans also help exciting companies expand their operation. Loans allow for growth in the overall money supply in an economy and open up competition by lending to new business. The interest and fees from loans are a primary sources of revenue for many banks as well as some retailers through the use of credit facilities and credit cards. Components of a loan. There are several important terms that determine the size of a loan and how quickly the borrower can pay it back. First, principal. This is the original amount of money that is being borrowed. Second, loan term. The amount of time that the borrower has to repay the loan. Third, interest rate. The rate at which the amount of money ought to increase, usually expressed in terms of an annual percentage rate (APR). Fourth, loan repayments. The amount of money that must be paid every month or week in order to satisfy the terms of the loan, based on the principal, loan terms, and interest rate. This can be determined from an amortization table. In addition, the lender may also take on additional fees such as an original fee, servicing fee, or late payment fees. For larger loans, they may also require collateral such as estate of a vehicle. If the borrower defaults on the loan, these assets may be seized to pay off the remaining debt. Tips on getting a loan. In order to qualify for a loan, prospective borrowers need to show that they have the ability and financial discipline to pay the lender. There are several factors that lender consider when deciding if a particular borrower is worth the risk. Income. For larger loans, lender may be require a certain income threshold, thereby ensuring that the borrower will have no trouble making payments. They may also require several years of stable employment, especially in the case of home mortgage. Credit score. A credit score is a numerical representative of a person's creditworthiness based on their history of borrowing and repayment. Missed payments and bankruptcies can be cause serious damage to a person's credit score. Debt to income ratio. In addition to one income, lenders also check the borrower's credit history to check how many active loans they have at the same time. A high level of debt indicates that the borrower may have difficulty repaying their debts. In order to increase the chance of qualifying of a loan, it is important to demonstrate that you can use debt responsibly, pay off your loans and credit cards promptly, and avoiding taking on any unnecessary debt. This will also qualify you for lower interest rates. It is still possible to qualify for loans if you have a lot of debt or a poor credit score, but these will likely come with a high interest rate. Since these loans are much more expensive in the long run, you are much better off trying to improve your credit scores and debt to income ratio. For more videos, please like and subscribe my channel. Thank you, friends.